Now, in segment 3, we're going to go deeper into what is happening abroad. Where are things going? How are crudes moving? And we continue to see those builds on the refined product side, but we want to be more specific because, okay, well, refined products are building, but that's a wide bucket. That's a big bucket. Let's break it into its pieces. And again, it's the light distillate gasoline side that continues to go up, but there still remains a lot of crude on the water. And this is all coming back to Russia. As we talked about in segment 1, you continue to see the amount of crude just increasing, miles per ton are increasing. And that's why we remain at a 2022 high of the amount of crude in motion, which, as you can see, is well above what has happened over the last 4 years. But then obviously 2020 was a unique year. But you can see that drop off, and we expect to see 2022 remain elevated and set new all-time highs even above 2020 as the comps continue to get easier and as the Asian markets continue to absorb a significant amount of Russian cargoes, and that's where we continue to see those movements. But as we have Libyan disruptions, potential CPC disruptions, that's also going to cause Europe to buy more from further away, which again is going to put more crude on the water, which is going to keep all of these numbers very elevated as we go through the remainder of this year. So crude oil in transit, when you're looking at what is driving it, crude oil in transit is already above the 2020 level. So again, the difference between total crude oil and the water is looking at both is transit plus floating storage. So this is just now going to break it into its pieces where you can see crude oil in transit is already at a record, for a seasonally adjusted record. It's still just below the high set for 2022. We expect this to, again, remain elevated, continue to set records as we continue to have more and more crude put on the water. Floating storage continues to move up. When you look at it, that orange line is just the average, which you can see is obviously skewed from 2020. So seasonally speaking, if you take out 2020, where we have a seasonally adjusted all-time high of floating storage. But one of the things that we've been saying is we're going to continue to go sideways, and we're going to track 2021 numbers just slightly above them. And it's just because we have so much crude in floating in transit that those timing delays are going to create a little bit of lumpiness on the floating storage side, but average out just above where we were in 2021 as those shifts continue, with a lot of that being in Asia. So here you can see that Asia floating storage is above 2021 levels. We expect this to continue to go up, especially as more Asian cargoes show up. And we continue to have a problem with the refining capacity within China. And again, that's a broad statement because the issues are more along the large facilities and state-owned facilities, because Shandong and the teapots continue to ramp up and are coming closer to where they were in 2021. And so far, and it's funny because China's been trying to shut down the teapots, but they've been essentially the juggernaut in terms of fulfilling what is needed in China, both during COVID and now post-COVID. And this is going to, again, throws another wrinkle in terms of why they want to close them so well. We know why they want to close them so badly, because they want to control and have more state-owned assets. But this is going to be the pivotal piece, is as these guys continue to run, they're running out of storage on the refined product side. So they're going to have to get issued additional export capacity, or else they're going to have to cut runs just because they physically won't have anywhere to put those products. And that's going to become some of those swings. As we said in segment 1, they've increased the amount of product exports, but it's still 40% below last year. And we do expect to see another round of export quotas because the local market is saturated, even as demand is starting to recover post-lockdowns. It's still saturated, and the global market, especially on the diesel side and distillate side, is very healthy. So you can make a great margin, especially because when you look at China, they're making this product now with and then going forward with very cheap Russian crude. So if you're buying crude, $40 to $50 below market, but then you're selling product at market rate, you're making a huge delta between those two. So again, it's going to be in their best interest to continue that activity as West Africa, as we said last week, was getting way more competitive on pricing. And because of the European concerns on Libya, on CPC, on these different flows, they rushed out and they were able to pick up some fairly discounted West African grades, which again has brought that floating storage back into normal. Now the question is going to be, as we have Asia slowing, are we going to see some of this come down? And the other key piece is Saudi Arabia cut some of the medium and heavy sides, which again is going to attract more purchasing from the U.S. versus West Africa. So we do expect this to reverse a bit and go back towards those 2021 highs, given those different shifts. China's supertanker crude imports, this is just the amount of crude that is targeting China, continues to fall. And again, it's just because they have elevated elevated storage, and these timing delays are going to be key. But you can see seasonally, they normally come down and then they start to rally back up as we get into July. But again, it's going to take time to see some of this normalcy, but we do expect this to come back, and we do expect this to continue to move as they're picking up some of this discounted oil. Now, when we look at U.S. crude product flows, you can see that gasoline had an increase of 46,000 barrels a day, still remaining strong. Distillate, 17,000 barrel a day drop. We expect distillate to hold to the 5-year average or just below. Gasoline to hold above the 5-year average, just given the flows into Latin America and PADD 3 trying to manage some of those flows. Propane is what we were talking about before. There was a huge surge in exports, 389,000 barrels a day additional. That's 744,000 barrels above the 5-year average, bringing us to 1.68 million barrels a day. Very strong, very elevated. That's going to remain the case. There will be obviously lumpiness, as we've talked about, with the geographical issues in terms of some of the canals, but it's still going to stay strong. Crude exports dropped 768,000 barrels a day. A lot of that is timing. We do expect that to increase and remain, as we've said, at that 3.4 million barrel a day. We did get more purchases from South Korea and Japan. That's going to stay the case. But the other key component that we've been talking about, shipments of Middle Eastern crude and condensate this month to U.S. buyers are set to reach the strongest level since May of 2020, as U.S. refiners have sought crudes with higher vacuum gas oil or VGO yields to replace the sanctioned Russian VGOs in order to fully use the FCC units. Medium sour crudes from the Middle East suppliers, especially Saudi Arabia and Iraq, are suitable for U.S. refiners, which, if you remember, they dropped those prices, which again is going to pull a lot of that additional crude right into the market, and that's going to be a very strong move, which is why we do expect to see a bigger increase in pricing, as we said in segment 1, that you did have Saudi Arabia cut medium and heavy crude differentials bigger than, and they kept those light differentials very elevated back to the highs. But they did have a sizable disconnect now with the mediums and the heavies to spreads that we haven't seen since 2014. So now when we look at gasoline exports here, you can see setting those new seasonally adjusted highs. We expect it to, again, be either right above the top of the cloud or just at the very top of the cloud, but still staying strong. Where when we start looking at the different pieces from U.S. distillate, as we were saying, we expect it to be either just below or right at the 5-year average for the distillate side, as the PADD 3 tries to again manage those flows. U.S. ethane exports starting to bounce back up. Again, it's just going to stay at the highs, either seasonally adjusted all-time highs or at least at the top of the cloud. But realistically, the year of 2022 will set a record when you average it out in general. U.S. exports, as you can see, just fell back to the 5-year average. But when you look at the 4-week rolling average, you can see we're still sitting at that 3.322. And it's just, we expect to come back to that 3.4, 3.5, again, seeing that elevated flow, especially with those disconnects between Libyan crude, CPC. And now that you have Saudi Arabia gunning light sweet, well, you can just pull it from the U.S. at this point. So that's, again, going to support U.S. flow, both into Asia as well as into Europe. And then as the U.S. exports that light sweet, we're going to see that increase in imports of the Middle Eastern crude, specifically Saudi Arabia and Iraq, into the U.S. and into Europe. So propane, this is what we were talking about, new seasonally adjusted all-time highs, new high for 2022. So again, still everything moving along at a positive clip. As we said before, the Dubai swap versus Brent continues to be at over $12, again supporting why we had that increase in pricing from Saudi Arabia. It's just the spreads continue to remain elevated. Now, when we start looking at Singapore refiner margins, they still remain elevated. They have fallen a bit, but again, it's just going to be a matter of timing as that light distillate side starts to weigh on it a bit. But distillate continues to be very robust. As you can see, this has come down a bit as well. Unfortunately, this data hasn't updated since the 24th, but it has come back. It's just come closer to that low end that we had in the beginning of June, but still at a very strong margin. Now, when we start looking at total flows, you can see that Russia continues to push higher. We expect it to come back to that, again, that 4.1 million barrels a day. And that's just on an estimate. Realistically, they've been at about 3.8, 3.9, because remember, there is some of that limitation in general. Then when you look at Angola, Nigeria continues to be fairly stable. North Sea has had that step up to about 750,000 barrels a day. And then when you look at Libya, we expect to stay closer to that 600,000 to 700,000 barrel a day flow. So that's where we're going to see some of that disconnect while the other areas continue to match. Russia plans to export about 28 cargoes of Urals from the Baltic ports in July, which is fairly stable, equates to about 2.8 million tons or 662,000 thousand barrels a day, compared with the 2.9 or 709,000 barrels a day in June. And some of that slowdown is just from Asia. But again, you're still seeing it remain elevated. India imports of Russian oil surged 50-fold, just to give you an idea of where they were, which is back to that they're on track to hit between 1 to 1.2 million barrels a day. And then obviously China's increasing. So those flows are going to continue to move into that Asian theater. And then when you start looking at falling short, so when you look at who is falling short, we continue to try to highlight who, and it's Russia, Nigeria, Angola, Malaysia. Some of that Malaysian crude was Iranian, which is now just blatantly Iranian. But again, Nigeria, Angola is the crux. Russia's obviously dropping, but they're seeing limitations as to where it can go, and they have an issue with production. With storage. So they have to manage this, and that is really the driver. But the one that doesn't have those issues is West Africa. But Russia's taking even more. So West Africa was already facing a demand problem in Asia, and now Russia is just taking additional market share, again, weighing on some of those issues. Genscape, European storage, as we were saying, we expect it to be fairly flat here and just fairly lumpy. We've had a sizable increase in floating storage, so it's just going to be a matter of that switching back and forth. Now, when we start looking at the storage levels, you can see that gas oil had another draw of 22. It's still, we expect it to make new seasonally adjusted all-time lows. A lot of headwinds when we're looking at it. Fuel oil exports started to increase. There's a mixture of recracking as well as just exports into the European market, into the Asian markets. And then gasoline had another build of 10 and coming in very elevated and again setting a new all-time record. And just to put that into perspective, you can see that, it's still below where they were in 2020, but when you can see just how close it is to those 2020 levels and continues to be at a very elevated component, which is why we expect to see more exports coming through and them trying to manage some of these additional storage levels, as fuel oil continues to be fairly stable along these lines, and we expect that to remain the case. Now, on the Singapore front, you can see that the total weekly fuel stockpiles increased from 43.9 to 45.9. Still moving higher. We expect it to stay above that 15-year average, 17-year average. But again, it's still going to be driven by light distillate, which had that sizable increase. And now this had a seasonally adjusted all-time high. So it made a 2022 high It's above where we were in 2020 as we continue to see the slowdown in gasoline consumption and more of that being pushed into storage. And then when you look at the middle distillate side, you can see that we're back down to the lows, just above the new seasonally adjusted all-time lows. We expect it to continue to be the case, and that's why the crack spreads remain strong, is again filling this void of the middle distillate side, as residual fuel and heavy disti continues to be fairly stable, right around the average. Now, when we start looking at Fujairah, total products had a build of 2.88 million barrels, and that's the highest they've been this year. And again, we continue to see that trending up. Stocks of light distillate, including gasoline and naphtha, rose 385,000 barrels. There's some support, but again, you're starting to see some of that disconnect as we continue to see some additional capacity and storage coming through, and we expect gasoline to continue to move higher. Middle distillate rose 919,000 barrels a day, up to 3.8 million. It's the highest level since last October. To give you an idea of some of this slowdown, some of this buildup, middle distillate complex was under some downward pressure as rising supply incentivized by robust gas oil cracks, along with some signs of weakening demand, weighed down sentiment in the market. And when you start to look at it, as we were saying, Saudi Arabia and the Middle East are producing more as they bring on new refineries and again ramp them up. And this excess is going to be exported into Europe. Europe is importing at levels not seen since 2020. We're going to continue to see that move through, and some of this will end up in PADD 1 as well, or the East Coast. Heavy resid increased 1.576 million. That's when you look at it, they've reached 12 million barrels in storage for the first time since June of last year at 12 points, and that sits at 12.62 million. And again, when you look at this, it's just slowing demand, slowing trade, that's just resulting in more heavy disti and resid being left in storage. The Brent time spread still remains strong. It's why we expected to see this bounce. For those that read us with Anas, we were saying that we were going to average in the back half of the year between 105 and 108. So again, this fall below 100 was a buying opportunity, as you can see from some of these Brent, the time spreads in general. North Sea crude oil and floating storage bounced. We expect this to, again, waffle back and forth depending on pricing. The prices get cut, or some of this will move into onshore storage. Now, Middle East is starting to see a bit of an increase in floating storage. We expect them to try to manage this, which is why we've actually been calling for that disconnect between light crude and heavy crude. And here we finally got it, and this is going to help them, again, really kind of hold flat some of these moves. And as we were saying last week, the drop in floating storage also gave them the confidence that they could raise OSPs on their flagship crude. And at the same time, the spread between Brent and Dubai also gave them that ability, but they can also help refiners a bit by pushing out some of those heavier grades, as European floating storage dipped down a bit but still remains a little bit higher, which again is going to support some additional increases in onshore storage within the European markets. So that's what we have for you today. If you have any questions, again, you can find us in the comments section or on Twitter. Hopefully this was helpful. And as we said before, we hope you had a great holiday weekend. And for those, you probably have a nice holiday week ahead of you. So hopefully when you're watching this, we're helping you get caught up on what you missed and hit the ground running next week. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.